All right, Chapter 14, Lesson 3, Promissory Notes. Sort of like a loan, right? So some businesses use promissory notes as a form of promise to pay, which is crazy that you would do that in a company, but I guess bad times happen, and they're needed. So cash is the primary medium of exchange for business transactions. Cash is used to purchase merchandise and to pay salaries, etc. In turn, businesses receive cash when they sell their products or services and collect payment. Sometimes the receipt of cash from sales does not occur at the same time and in amounts sufficient to pay for needed purchases and expenses. So the company doesn't have enough money to pay its own bills because it's not getting enough money in. When this occurs, a business must make arrangements with its vendors to delay payments or to borrow additional cash. Generally, when a bank or business lends money to another business, a loan agreement is made in writing. And that is what a promissory note is. A written and signed promise to pay a sum of money at a specific time is called a promissory note. Promissory note? A person or business to whom a liability is owed is called a creditor. It's the people that give you money. A promissory note signed by a business and given to a creditor is entered into the business books as a note payable. Note payable and notes receivable are frequently referred to simply as notes. A promissory note that a business accepts from a customer is entered in the business books as a note receivable. The person or business that signs a note and thus promises to make payment is called the maker of a note. Let's see. The person or business to whom the amount of a note is payable is called a payee. The original amount of a note, sometimes referred to as the face amount, is called the principal. The percent of the principal that is due for the use of the funds secured by a note is called the interest rate. So you borrow money, and that is your principal. That is the amount of money you borrow. Interest is charged on that money you borrow, and that's how the creditor makes money. It's called the interest rate. The date on which the principal of a note is due to be repaid is called the maturity date. Everything is due at a certain time. You can't just borrow money indefinitely. And the length of time from the signing date to the maturity date, usually expressed as the number of days, may be referred to as the time of a note or the term. To be legally enforceable, a signing of a promissory note must be witnessed by a person who is not a party to the agreement. The witness must also sign the note. Here we have an example of a promissory note. Note number 6, Skinner College with an address. For the value received, the signer promises to pay to the order of 3 green products, 90 days from the date. There's the date for that price. 8% annual interest rate of 8% due on June 16th, March, April, May, June. That's 90 days, 3 months. Signed, and then a witness. And everything we just said. Maturity date, maker of the note, and witnesses. Accepting a note receivable from a customer. On occasion, a customer may be unable to pay an amount owed to a business by the due date and might request additional time. The business should require the customer to sign a promissory note. A note does not pay the amount the customer owes. The form of the asset is changed from an account receivable to a note receivable. Notes are written confirmation of the amount owed that provides the business with legal evidence of the debt should it be necessary to go to court to collect. Basically, if a customer needs more time and the business is okay with it, they have to write it down. They can't just say, oh yeah, take as much time as you need. It can't be a verbal promise. It has to be in the form of a note because then you have legal evidence. An amount paid for the use of money for a period of time is called interest. Some promissory notes are issued with interest. So our first example, March 18th, accepted a 90-day 8% note from Skinner College. Basically, we have here our general ledger account, notes receivable increases, the accounts receivable decreases by the same amount on the same date, and then the accounts receivable ledger decreases by the same amount on the same date. And we said when a customer signs a note, the principal amount is debited to an asset account titled Notes Receivable. Like accounts receivable, notes receivable is an asset with a normal debit balance. One asset, an account receivable, is replaced by another asset, a note receivable. The transaction is posted to the general ledger and accounts receivable ledger the transaction is posted to the general ledger and accounts receivable ledger accounts using the same posting procedure. The words accepted note are written in the item column of the customer account to show the full credit history for the customer. And that's what I just said. I'm sorry, I forgot to hit forward. So here we have notes receivable, accounts receivable Skinner College with a dash, which we'll fill in at a later date. The date, account title, notes receivable number, the amount, account number and customer name, which we're going to put in the account number and a customer number here, and then the credit amount. Interest on promissory notes, an amount paid for the use of money for a period of time is called interest. We've said that a few times now. Principal times the annual interest rate times time as a fraction of a year is the interest for the fraction of the year, and we'll go through an example. We have a principal amount. Our interest rate is 8%. 90 over 360, that is time as a fraction of a year. So it's only a 90-day note. It has to be a fraction of a year because we said this was an annual interest rate. So the amount times 0.08 times this division, that's the interest that they're paying on that note. The amount that's due on the maturity date of a note is called the maturity value, which would be your interest plus your principal. Awesome. Maturity date of a promissory note, the number of days of the first month, okay, the first month, days remaining after this month. So we've got the first month, second month has 30 days, third month has 31 days. Because it's a 90-day note, we just need to figure out when it's due. Less are the days of the month, the days remaining for the last month. So March 18th was when the note was written. It's due on June 16th, which is 90 days. Collecting principal and interest on a note receivable. When a note receivable reaches its maturity date, the maker of the note is expected to pay the maturity value to the payee. The interest earned on the money it loaned is called interest income. The interest earned on a note receivable is credited to the revenue account titled interest income. The interest earned on a note receivable is credited to a revenue account titled interest income. So interest income is investment revenue rather than revenue from normal operations. Therefore, interest income is listed on the chart of accounts under classification other revenue. So we have interest income right here, and that increases. Our cash, when they pay it, increases, and then our notes receivable would decrease in that amount to make a balance zero. Okay, we have the date, notes receivables, the account title. We have our receipt number, 782, principal amount, interest income. So we have our original principal amount and then our interest income. and they would add together to give us our total. Recording a dishonored note receivable. A note that's not paid when due is called a dishonored note. First example, June 3rd, Stout Company dishonored note receivable 4. So the interest income on the note has been earned. The interest income on the note has been earned as of the maturity date, even though the note has not been paid. Stout Company owes the principal amount of the note plus the interest earned. Therefore, the maturity value of $3,040 is debited. It's debited to accounts receivable to the Stout Company. So it's debited to the accounts receivable and to Stout Company in the accounts receivable ledger. One asset, a note receivable, is replaced by another asset, an account receivable. So 3 Green actually doesn't write off this account, Stout Company's account, when the note is dishonored. The company continues to try to collect the account. Later, the company may decide that the account cannot be collected. At that time, the balance of the account will be written off as an uncollectible account. So the transaction's posted to the general ledger, and the accounts receivable ledger accounts using the same posting procedure we've done before. The words dishonored note are written in the item column. So let's look at it. Accounts receivable, Stout Company, debit, notes receivable has a credit and interest income to make that 0. We have memorandum 98. All right, what conditions might cause a business to delay payment to a vendor? If the receipt of cash sales does not occur at the same time in an amount sufficient to pay for needed purchases and expenses. So they've sold product, they've received payment for product, but it isn't quite not occurring at the same time, so they may not be able to pay their salary. What is the advantage of a promissory note over an account? Promissory note over an account receivable. A note can be useful in a court of law as written evidence of a debt. What does an interest rate of 10% mean? 10 cents will be paid for the use of each dollar borrowed for a full year. So you take the 10% of the principal, and that is the interest earned or the interest income. What is written in a customer's account when 1, a note is accepted, and 2, a note is dishonored? The words accepted note and dishonored note are written in the item column of the customer's account. Yay! And that's all.